it on 30th of September. As you are aware, this process of the governor making a statement started on March 27th when we entered the period of the pandemic. And thereafter we have continued with this practice because we have been confronted with, the world has been confronted with one crisis after the other. And this statement by the governor RBI, where we spell out the details of RBI's assessment of domestic and global situation, I think is an useful communication tool for all the stakeholders and members of the public. That is the feedback we have received. Thank you for all your patience and cooperation in listening to our communication. And please permit me now to go ahead with this time's statement. In the last 2.5 years, the world has witnessed two major shocks: the COVID-19 pandemic and the conflict in Ukraine. These shocks have produced profound impact on the global economy. As if that was not enough, now we are in the midst of a third major shock, a storm arising from aggressive monetary policy actions and even more aggressive communication, especially from advanced country central banks. The necessity of such actions is driven by their domestic considerations, but in a highly integrated global financial system, they inevitably cause negative externalities through spillovers. The recent rate hikes and forward guidance about further big rate hikes have caused tightening of financial conditions, extreme volatility, and risk aversion. All segments of the financial market, including equity, bond, and currency markets, are in turmoil across countries. There is nervousness in financial markets with potential consequences for the real economy and financial stability. The global economy is indeed in the eye of a new storm. Despite this unsettling global environment, the Indian economy continues to be resilient. There is macroeconomic stability. The financial system remains intact with improved parameters. The country has withstood the shocks from COVID-19 and the conflict in Ukraine. Our journey over the last 2.5 years, our steely resolve in dealing with the various challenges, gives us the confidence to deal with the new storm that we are confronted with at present. Let me now touch upon the decisions and deliberations of the Monetary Policy Committee. The Monetary Policy Committee met on 28th, 29th, and 30th September. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 5 members out of 6, and you guessed it right, to increase the policy repo rate by 50 basis points to 5.9% with immediate effect. Consequently, the standing deposit facility, that is SDF rate, stands adjusted to 5.65%, and the marginal standing facility, that is MSF, and bank rate to 6.15%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. I would now like to explain the MPC's rationale for its decisions on the policy rate and the stance. The global economic outlook continues to be bleak. Financial conditions are tightening and recession fears are mounting. Inflation continues to persist at alarmingly high levels across jurisdictions. The enduring effects of the pandemic and the geopolitical conflict are manifesting in demand-supply mismatches of goods and services. Central banks are charting new territory with aggressive rate hikes, even if it entails sacrificing growth in the near term. In this milieu, nervous investor sentiments have triggered a flight to safety. The US dollar has strengthened rapidly to a 2-decade high, several advanced and emerging market currencies are facing sharp depreciation pressures. Emerging market economies, that is EMEs in particular, are confronted with challenges of slowing global growth, elevated food and energy prices, spillovers from advanced economy policy normalization, debt distress, and sharp currency depreciations. Now, against this challenging global environment, economic activity in India remains stable. And that's a very refreshing point. It gives us, that's why in the beginning I said that it gives us the confidence of even dealing with the current challenge which we are confronted with. While real GDP growth in the first quarter this year turned out to be lower than our expectations, nonetheless it was 13.5 and perhaps the highest among the major global economies. So the real GDP growth in the first quarter, the late recovery in Kharif sowing, and the comfortable reservoir levels that we have at present, improvement in capacity utilization, buoyant bank credit, and government's continued thrust on capital expenditure are expected to support aggregate demand and output in the second half of the current year. Consumer price inflation remains elevated and above the upper tolerance band of the target due to large adverse supply shocks, some firming up of domestic demand, and the spillovers from global markets. The recent correction in global commodity prices, including crude oil, if sustained, may ease cost pressures in the coming months. The inflation trajectory remains clouded with uncertainties arising from continuing geopolitical tensions and nervous global financial market sentiments. In this backdrop, the MPC was of the view that persistence of high inflation necessitates further calibrated withdrawal of monetary accommodation to restrain broadening of price pressures, anchor inflation expectations, and contain the second round effects. This action will support the medium-term growth prospects of our economy. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 5.9% and to remain focused on withdrawal of accommodation while supporting growth. Now, let me step back a little and elaborate on our monetary policy stance. Monetary policy had moved from neutral to accommodative stance in June 2019. At that time, repo rate was 5.75%. Headline CPI inflation was hovering around 3% and was expected to be in the range of 3.4 to 3.7% in the second half of 1920, and liquidity was in deficit mode with an average daily injection of 0.3 lakh crore in May 2009 under the Liquidity Adjustment Facility, that is LAF. Today, inflation is hovering around 7%, and we expect it to remain elevated at around 6% in the second half of this year. Liquidity remains surplus with average daily net absorption of rupees 1.1 lakh crore under the LAF in September 2022, and this is up to 28th September. As government expenditure picks up on the back of high GST and direct tax collections, the system liquidity will go up further. Thus, even as the nominal policy repo rate has been raised by 190 basis points so far, including the increase that we have effected today, the policy rate adjusted for inflation trails the 2019 level. The overall monetary and liquidity conditions, therefore, still remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation, and first let me take up growth. Real GDP grew by 13.5% year on year in the first quarter of this year, this financial year, that is 2022-23. Now this surpassed the pre-pandemic level by 3.8%. This was led by robust growth in private consumption and investment demand. High-frequency data for the second quarter indicate that economic activity remains resilient. Private consumption has been holding up. There is sustained revival in urban demand, which should get a further impetus from the unfettered celebration of upcoming festivals after 2.5 years of living with the COVID-19 pandemic. Rural demand is also gaining gradually. Investment demand is picking up and is evident from the robust growth of domestic production and import of capital goods in July and August. Bank credit has grown at an accelerated pace of 16.2% year-on-year as on September 9th, as against 6.7% during the corresponding period of last year. Total flow of financial resources from banks and non-banks to the commercial sector has improved significantly to rupees 9.3 lakh crore in this financial year so far, that is up to September 9th, from 1.7 lakh crore in the corresponding period of last year. So this year the flow of commercial resources is 9.3 lakh crore compared to last year figure of 1.7 lakh crore for the same period. According to the RBI survey, seasonally adjusted capacity utilization of the manufacturing sector improved from 73% in the fourth quarter of 21-22 to 74.3% in the first quarter of 22-23. And this is in fact the highest level in 3 years. Last time I had given that the decline, I had given the unadjusted capacity utilization which had improved. That's what I had stated in the last monetary policy meeting. But I think it's always better that and that reflected the seasonal pattern. So therefore, I think it is always better to look at the seasonally adjusted figures, and that is what I have attempted to provide today. Non-oil, non-gold imports remained resilient, indicating sustained revival in domestic demand. Merchandise exports growth, however, faced headwinds from unsettled external environment. In the supply side, the agricultural sector remains resilient. The monsoon rainfall was 7% above the long period average as on 29th September. Kharif sowing was 1.7% above the normal sown area as on 23rd September. The production of Kharif food grains as per the first advance estimate is only 0.4% below the first advanced estimate of last year. The reservoir levels are at 87% of the full capacity on 29 September as against the decadal average of 77%. This augurs well for the ensuing Rabi crop. Now, we decided to provide all these numbers so that there is clear communication about where exactly we stand in the agricultural front. Industrial activity, as reflected in the growth of index of industrial production, slipped to 2.4% in July. India's manufacturing purchasing managers index, that is PMI, the manufacturing PMI, however, indicates sustained expansion at 5.2 in August. Business sentiment, as reflected in the manufacturing PMI, strengthened with the degree of optimism at its highest in 6 years. Service sector indicators point towards strong growth in July and August. Services PMI rebounded to 57.2 in August from 55.5 in July. Business confidence rose to a 51-month high. So I have first provided where we stand with regard to aggregate demand, where we stand with regard to aggregate supply, and within that I have focused on the agriculture sector, the industry sector, and the services sector indicators. Now, looking ahead, all these factors should support aggregate demand and activity. The headwinds from extended geopolitical tensions, tightening global financial conditions, and possible decline in the external component of aggregate demand can pose downside risks to growth. Taking all these factors into consideration, which I have just narrated, real GDP growth for the current financial year 2022-23 is now projected at 7%, with second quarter at 6.3%, third quarter at 4.6%, and the fourth quarter at 4.6%, with risks broadly balanced. The growth in the first quarter of next financial year, that is 23-24, is projected at 7.2%. I would now like to focus on inflation. Global geopolitical developments are weighing heavily on the domestic inflation trajectory. Inflation inched up to 7% in August from 6.7% in July. Acute imported inflation pressures felt at the beginning of the financial year have eased, but remain elevated across food and energy items. Edible oil price pressures are likely to remain contained on improved supply from key producing countries and measures taken by the government. Going forward, there could be some tapering of selling price increases on account of easing supply conditions and softening of industrial metal and crude oil prices. With services activity showing strong rebound and some improvement in pricing power, risks of higher pass-through to input costs, however, do remain. There are also upside risks to food prices. Cereal price pressures is spreading from wheat to rice due to likely lower Kharif paddy production. The lower sowing of Kharif pulses could also cause some pressures. The delayed withdrawal of monsoon and intense rain spells in various regions have already started to impact vegetable prices, especially tomatoes. These risks to food inflation could have an adverse impact on inflation expectations. The Indian basket crude oil price was around 104 barrel in the first half of this year, 22-23, and this is the actual number which has been realized. In the first half of this year, the Indian basket price was, the average was around $104 US dollars per barrel. Going forward, we are now assuming it to be $100 per barrel in the second half of this year. Taking into account these factors, the inflation projection is retained at 6.7% for the current year, with second quarter at 7.1%, third quarter at 6.5%, and fourth quarter at 5.8%, with risks evenly balanced. CPI inflation is projected to further reduce to 5% in the first quarter of next financial year, that is 23-24. The extraordinary global circumstances that caused the heightened inflationary pressures have impacted both advanced economies as well as the emerging market economies. India is, however, better placed than many of these economies. If high inflation is allowed to linger, it invariably triggers second-order effects and unsettles expectations. Therefore, monetary policy has to carry forward its calibrated action on policy rates and liquidity conditions consistent with the evolving inflation growth dynamics. It must remain alert and nimble. I would now like to focus on the liquidity and financial market conditions. During the current financial year, the weighted average call rate, that is WACR, the operating target of monetary policy, has increased cumulatively by 196 basis points, that is 196 basis points in a phased manner up to September 28th over March 22. This is in sync with our actions on the SDF and the repo rate. Consequently, interest rates across financial market spectrum have increased, though at varying degrees. Surplus liquidity in the banking system, as reflected in the average daily absorption under the Liquidity Adjustment Facility, that is LAF, including both SDF and the VRRR auctions, moderated to 2.3 lakh crore during August to September, that is during this period of August and September up to 28th September, it moderated to 2.3 lakh crore from 3.8 lakh crore during June-July. So it was 3.8 lakh crore during June-July, and in August-September up to 28th September, the overall system liquidity has moderated to 2.3 lakh crore, and that is evident from the overall LAF position and taking into account both SDF and the VRRR auctions. GST and advance tax payments coupled with forex outflows moderated the surplus liquidity conditions in the third week of September. This necessitated recourse to marginal standing facility by banks and liquidity injection by the Reserve Bank through variable rate repo auctions. And this is exactly in line with what we had said earlier, that the situation, the liquidity situation is constantly monitored, and as and when required, the RBI will conduct fine-tuning operations both to inject liquidity as well as to absorb liquidity. Now, this temporary moderation of surplus liquidity needs to be seen in the context of the large potential liquidity in the system arising from the expected pickup in government spending that usually happens in the second half of the year. Furthermore, drawdown of excess CRR and excess SLR holdings of banks can also augment system liquidity. In my statement of October 2021, I had stated that the Reserve Bank may complement the fortnightly main operation conducted through 14-day VRRR auctions with 28-day VRRR auctions, depending upon the evolving liquidity conditions. In view of the moderation in surplus liquidity, it has now been decided to merge the 28-day VRRR with the 14-day main auction under VRRR. Consequently, from now on, only 14-day VRRR auctions will be conducted. And as I just mentioned a little while ago, fine-tuning operations of various maturities for absorption as well as injection of liquidity will continue as may be necessary from time to time. During the current financial year up to September 28, the US dollar has appreciated by 14.5% against a basket of major currencies. This has caused turmoil in currency markets across the world. The movement of the Indian rupee has, however, been orderly compared to most other countries. The Indian rupee has depreciated by 7.4% against the US dollar during the same period. That is from 1st April of this year to the date which I just mentioned, that is up to 28th September. So while the US dollar has appreciated by 14.5%, the Indian rupee has depreciated in a very orderly manner by 7.4%. And consequently, it is evident that the Indian rupee has fared much better than several reserve currencies as well as many emerging market and Asian peers. A stable exchange rate is a beacon of financial and overall macroeconomic stability and market confidence. In recent days, there have been divergent views on the exchange rate of the rupee and the adequacy of our forex reserves. Let me set out the overall position once again. First, the rupee is a freely floating currency and its exchange rate is market determined. Second, the Reserve Bank does not have any fixed exchange rate in mind. The Reserve Bank intervenes in the market to curb excess volatility and anchor expectations. The overarching focus is on maintaining macroeconomic stability and market confidence. Our actions have helped in encouraging investor confidence as reflected in the return of capital flows since July. Over the medium term, the primacy of price stability embedded in our flexible inflation targeting framework provides the anchor for exchange rate stability. these are the 2 points which I mentioned. I would now like to mention the third point. Third, our interventions in the forex market are based on continuous assessment of the prevailing and evolving situation from the point of view of the approach which I just explained. The aspect of adequacy of forex reserves is always kept in mind. The umbrella, as I had said earlier, continues to remain strong. During the pandemic, forward guidance gained prominence in Reserve Bank's communication strategy. This was helpful in anchoring market expectations. In a policy tightening cycle, however, it is arduous to provide consistent forward guidance, particularly in a highly uncertain environment. In fact, forward guidance may even destabilize financial markets. Questions are often asked about the peak and terminal rates in a rate hiking cycle or in a rate tightening cycle. Without venturing into any forward guidance which can be hazardous in the present context, I would like to state that our actions will be carefully calibrated to the incoming data and the evolving scenario without being constrained by conventional or any textbook approach to policy making. Let me now focus on the external sector. The current account deficit for the first quarter 2022-23, and that was released last evening, is placed at 2.8% of GDP, with trade deficit at 8.1% of GDP. Various leading indicators, including global PMIs, point to weakening of global growth momentum and downside risks to global trade. India's import growth, though decelerating, outpaced the export growth. Consequently, the trade deficit remained high in July and August. Services exports continued to grow at a robust pace amidst resilient demand for software and business services and modest recovery in travel services. On a balance of payment basis, that is on a BOP basis for which data were released yesterday, exports of services grew at a robust pace of 35.4% year-on-year during April-June this year. For the same period, remittances rose by 22.6%. The net surplus on exports of services is expected to partly offset the higher trade deficit. So as you can see, both services sectors have grown at a robust pace of 35.4% and remittances have grown by 22.6%, and that is why I am making the statement that the net surplus on exports of services is expected to partly offset the higher trade deficit. From the external financing side, net foreign direct investment, that is FDI, improved to 18.9 billion in April-July this year from 13.1 billion a year ago. Foreign portfolio investors, that is FPIs, have returned to the domestic market with a net inflow of $7.5 billion during July to September after an outflow for 9 consecutive months. India's foreign exchange reserves now stand at $537.5 billion as on September 23rd, and this compares favorably with most peer economies. And this is important, about 67% of the decline in reserves during the current financial year is due to valuation changes arising from an appreciating US dollar and higher rates of US and higher US bond yields. Incidentally, there was an accretion of $4.6 billion to the foreign exchange reserves on BOP basis during the first quarter of the current financial year. So it may be seen that our market interventions continue to be judicious. India's other external sector indicators, namely the external debt to GDP ratio, net international investment position to GDP ratio, ratio of short-term debt to reserves, and debt service ratio also indicate lower vulnerability as compared with most other major EMEs. In fact, India's external debt to GDP ratio is the lowest among the emerging market economies. In fact, in the final analysis, we remain confident of meeting our external financing requirements comfortably. I shall now announce certain additional measures, and I'll be very brief. There are just about 4 or 5 announcements. The first is that we will release a discussion paper on expected loss-based approach for loan loss provisioning by banks. Banks currently follow the incurred loss approach for provisioning of their loan assets, whereby provisions on loan assets are made after the stress has actually materialized. A more prudent and forward-looking approach is the expected loss-based approach, which requires banks to make provisions based on an assessment of the probable losses. As a step towards converging with globally accepted prudential norms, we will issue a discussion paper on the proposed transition for stakeholder comments. The second one relates to discussion paper on securitization of stressed asset framework. The revised framework for securitization of standard assets was issued by the Reserve Bank in September 2021. It has now been decided to introduce a framework for securitization of stressed assets. This will provide an alternative mechanism for securitization of NPAs in addition to the existing ARC route. A discussion paper on this proposed framework is also being issued for feedback from stakeholders. The third announcement relates to internet banking facility for customers of regional rural banks. Regional rural banks, that is RRBs, are currently allowed to provide internet banking facility to their customers, subject to fulfillment of certain criteria. Keeping in view the need to promote the spread of digital banking in rural areas, these criteria are being rationalized. The revised guidelines will be issued separately. And the final announcement relates to regulation of offline payment aggregators. Online payment aggregators have been brought under the purview of the Reserve Bank guidelines since March 2020. It has now been proposed to extend these regulations to offline payment aggregators who handle proximity or face-to-face transactions. This measure is expected to bring in regulatory synergy and convergence on data standards. Let me now conclude. Daunting challenges confront us at this juncture. The underlying fundamentals of our economy and the buffers built over the years have stood us in good stead. We have taken a series of measures since April 2022, that is in the aftermath of the commencement of the conflict in Ukraine and the kind of spillovers and the global impact it produced. We have taken a series of measures thereafter since April 22 in the backdrop of, as I said, geopolitical tensions, sanctions, and supply chain disruptions. We will remain resolute and persevere in our efforts to ensure price stability as well as financial stability, supporting growth. Our policy actions today is a part of our continued efforts in pursuit of these goals. As we celebrate Mahatma Gandhi's birth anniversary in another 2 days, I conclude my statement with Mahatma Gandhi's insightful words, and I quote, "We are wakeful, ever vigilant, ever striving," unquote. Today, despite the gathering clouds over the global economy, the Indian economy inspires optimism and confidence. Thank you. Namaskar.
तो क्रेडिट पॉलिसी में 0.5% ब्याज दर की